Welcome back to the Financial Symmetry Show, where we're passionate about helping you enhance your today and enrich your tomorrow in your ideal retirement. I'm Allison Berger, your host for today, and I'm joined by fellow advisor and partner Grace Cavantis. We're giving Chad the week off as he lives his best life on spring break with his family. So as we're thinking about and planning for our ideal retirement, many of us want to share our good fortunes with others who may be less privileged. This is also incentivized through the tax code. So being charitably inclined can also help to reduce your tax liability. Today, we're going to talk about some of the ways to take advantage of those opportunities while meeting your charitable goals. So Grace, what are some examples of charitable goals that you typically hear from clients?
Some charitable goals I hear from clients are things like wanting to donate a certain dollar amount or percentage of their income every year. As an example, maybe a 10% tithe or something like that. Some people want to donate a certain amount of money per month to maybe a particular type of charity, or some people might have a goal of when my bonus hits every year, I want to give 5,000 of that to my alma mater. Or some might want to make an endowment, so a big future donation to a particular cause. Some people want to use particular strategies like a donor advised fund or qualified charitable contributions, QCDs. And an interesting shift we see is that there are often different goals in one's working years than in one's retirement years. So it might shift from a certain dollar amount of coming in income every year to focusing more on estate gifting when you pass away, or wanting to give maybe a smaller amount because income's generally lower in retirement, not always, but generally, or giving a certain amount of your Social Security income or pension income or IRA distributions, whatever that might look like for your particular case. So those are some of the charitable goals I see.
Yeah, those are great points. And we're going to talk more about that shift from your working years to retirement today, because that is a significant change. And as we're thinking about our charitable intentions, I like to put this in the context of time, talent, treasure, because we're mostly talking about that treasure piece, the financial piece. But as you're making that shift, maybe in your working years, you did not have the time to give to charitable organizations or different causes that you're passionate about. And sometimes that changes. So maybe we look at those three and how we're comprising that as we're entering retirement, and we change how that pie is comprised. And as we're looking at our charitable intentions, we did want to point out all the good that's happening in the world. And we included this in a recent newsletter that we sent out to our clients, and we can link to the show notes as well, that looked back to the year 1850. And at that time, the world had 1.26 billion people, and over 87% of them lived in extreme poverty. And if we fast forward to today, we see our global population has expanded by 6.74 billion. However, the number of people living in extreme poverty has dropped to just 8% today. We know that there are many different factors that have contributed to that, but it's surely one of the greatest overlooked miracles of our modern age. And the work that many people are doing to different causes and organizations is contributing to that. So that's something that we want to encourage and continue to highlight, as sometimes we know news has a tendency to focus on the negative things that are happening, and those positive things are happening. And we know a lot of our clients want to be involved in that, both with how they allocate their time, talent, and treasure. And as we're thinking about our taxes, we never want to let the tax tail wag the dog here. So if we're making charitable contributions, we want to make sure we're being intentional and that those are in line with your family's values and long-term goals for helping others and improving society at large. And as Grace mentioned, many times clients already have those in mind, maybe a percentage or a dollar amount. And then as they're making that transition, we want to make sure that either what they've been doing during their working years or what they would like to do going forward is sustainable in terms of their financial plan and their other goals that they have for the rest of their retirement. And we also know income can fluctuate in retirement from year to year, either based on your withdrawal needs and also on market performance. So we may want to think less in terms of a percentage of income and more in terms of an overall charitable goal. So what we're going to do today, we'll do something a little bit different. And Grace is going to walk us through two case studies, one of clients who are on the cusp of retirement and one of clients who are already retired. And we'll talk about their charitable intentions and how they might save some additional tax dollars on that. And Grace and I both love Disney. So we're going to go with a Disney theme today. Grace, tell us a little bit about Mickey and Minnie.
All right, our first charitable contribution case is Mickey and Minnie. They are a couple that are ages 55 and 52. They're both still working. Mickey works for a large tech company and plans to retire at age 60. And Minnie runs a small cupcake shop, a small business, that she's in the process of selling to a larger company for $3 million. So we know they're going to have a year with a large income bump. As far as assets, they have $2 million built up in 401k accounts and IRAs, Roth IRAs, and $1 million in a brokerage account with large unrealized gains, which means that the amount they invested in it has grown quite a bit. So they have gains that would be taxable if they sold the things held in that account. Their income is $350,000 per year. And their main charitable goal has been to give away 10% of their gross income every year to their church and other various charities. They would like to potentially give more in the year of Minnie's business sale, but they're unsure if that's feasible. Another item of note that they would want to factor in is that Mickey's company, the large tech company, will match 50% of his charitable contributions up to $5,000. So that's something that if they can, they'd like to take advantage of. So Allison, what are some considerations they should make and maybe some recommendations we would have for them as they plan out their charitable giving?
Yeah, so this is great. So Mickey and Minnie have some unique characteristics here. The first one we want to look at is that company match that Mickey receives through his employer. And this is a great benefit of large companies. So if you are charitably inclined, you want to make sure you're taking advantage of any benefits that your company might offer. The company is going to match 50% of their charitable donations up to $5,000. So we want to make sure that they're doing $10,000 in a way that his employer recognizes. So this may be via payroll deduction. We see that through a lot of employers. You have to set it up through payroll deduction for them to offer that match and reimbursement. So we want to set that up to begin with. And then for the additional donations, what we see, if they're doing 10% of $350,000 a year, that's about $35,000 a year. And for a lot of people who are making that retirement transition, they might no longer be itemizing on their tax return. So they're likely going to be taking the standard deduction, which we're looking at 2022 numbers right now because we just are wrapping up that tax year. So we're going to stick with that. So for a married filing joint couple, the standard deduction is $25,900. And let's say Mickey and Minnie are giving away $35,000 a year. So we see that already exceeds the standard deduction. And then let's say they have $10,000 of state and local income taxes and $10,000 of mortgage interest. So now they're up to a total of $55,000 in itemizing their deduction. So they're getting that benefit. So that's really great. And of that $35,000 that they're donating, they're in the 24% bracket. So that federal savings on that donation is about $8,400 a year that they're saving right now. If they live in the state of North Carolina, then they're also saving about $1,750. However, if they live in Orlando, Florida, they might not be as concerned about that state tax savings. So that's what we're seeing just on a year-to-year basis for Mickey and Minnie. Now, the big consideration here is in the sale of Minnie's very successful cupcake business that she's running. She's going to be selling that for $3 million. We don't know what the basis is, but they're going to have a huge inflow in that year of the business sale. That's going to bump them into the highest income tax bracket for married filing joint couples, which is going to be 37% federal tax rate. So we want to think about that year. What are some things they could do to reduce their income? So if they want to stick with that 10% theme, maybe in that year, they could donate $300,000 to a donor advised fund. So that money doesn't have to go directly to the charitable organizations in that 1 year, as that may, flood an organization and be a little bit overwhelming as a 1 year contribution, depending on what charities they're considering. And they may also want to stretch that out. So they're smoothing out their charitable contributions over the course of their retirement and their lifetime. So if they donate that to the donor advised fund, that will save them 37% taxes on that $300,000 donations, which would be a saving of about $111,000 in federal taxes. And then on the North Carolina side, that would be about $15,000 in tax savings. Now we think about that $300,000, and you also mentioned they have some unrealized long-term capital gains in a brokerage account. So they can do that donation two ways. They can either donate cash directly from the business sale, or they could donate some of those appreciated securities. which if they were to sell those appreciated securities themselves, they'd pay long-term capital gains tax, which if that's in a year where their income is lower, a more typical year, that might only be 15%. So maybe let's just say the gains inside that account are $200,000. If they did that in a high income year, so for example, in the year of the business sale, if they sold those securities and then donated them, they'd have to pay over $47,000 in taxes on the sale of those securities. So by moving that to a charitable organization, you can either, donate directly to the donor advised fund or directly to a charity appreciated securities. Those entities do not have to pay tax on the proceeds. So you get that double benefit of you're removing this appreciated asset from your portfolio where you would have a tax liability, and you're shifting it to an organization that would not need to pay taxes on those proceeds. So those are really some things that they could look to in the next few years to save tax dollars that would also help them continue to make annual donations from their donor advised fund without that needing to come directly out of their retirement income. So that's what we're looking at for Mickey and Minnie. And then let's talk about our next couple. We have Donald and Daisy, who are already living their ideal retirement.
We do. So Donald and Daisy are charitably inclined and are retired. So they're ages 68 and 72. And Donald was a federal employee, and Daisy was a college professor. As far as assets saved up toward retirement, they have $1 million in a TSP for Donald. That's the government's version of a 401k. And they have $1.5 million in an IRA, and then $200,000 in cash bank savings. They're currently both receiving Social Security income and pensions, and the total of all of that is $200,000 per year. And that more than covers their annual living expenses. Their charitable goal is to donate $20,000 per year to various causes. They also donate a significant amount of their time to their local food bank and their church. Their mortgage is paid off, so they don't have mortgage interest to factor in. And they're concerned because required minimum distributions are starting, and that's going to give them more taxable income. So they're concerned about what could they do about that. They're also in the second tier for Medicare premium. So not at the cheaper level, but the second tier. And then they're both over age 65. So they are eligible for that slightly higher standard deduction. So those are some considerations and things they could think about. What are some potential recommendations we might give them?
Yeah, so on the face of it, it looks like Donald and Daisy are in really great shape. They have some really strong fixed income sources in their retirement. As federal employees and a college professor, they both have pensions, which is becoming increasingly rare. So most of their retirement income needs are met by their fixed income sources, Social Security and pension. So it sounds like they're not really relying on these retirement accounts that they've built up. They don't particularly need to make withdrawals from those, but we know that they're going to be required to start making withdrawals from those fairly soon. And that is going to increase their taxable income. And in most years, they're going to be in the 24% bracket. However, once those RMDs start, that might even bump them up into the 32% bracket, which is a pretty big jump. And the other item they'll have to think about is those income increases could also bump them into a higher bracket for Medicare premiums. So they could go from paying an additional $66 a month each, so $130 roughly a year or a month between the two of them, to an additional $100 a month each. So $200 a month each, $2,400 a year, increasing their outflows and what that surtax from the higher Medicare premiums entails. So those are some things that they should be concerned about going forward, because their tax liability is likely to go up when those RMDs begin. And right now we noted they're donating about $20,000 a year. And if we think about Donald and Daisy, they have no mortgage. State and local income taxes are probably fairly low. So they're most likely taking the standard deduction, which for them is $28,700 a year. But what we can think about doing is Daisy, we noted, is already 72. So she's already eligible to get started on qualified charitable distributions. So those you can begin at age 70 and a half. And what you can actually do is just direct a portion of a withdrawal from your IRA directly to a charitable organization. So you can do this up to $100,000 a year, even before you're required to start your RMDs, which has now been pushed back to 73 and 75 for retirees, depending on your date of birth. So if we're able to make that shift, and what we need to do on the tax return is we subtract that from the taxable amount. So let's just say that you took a $30,000 withdrawal from your IRA and $20,000 of it was directed directly to charity. On line 4A and 4B of your tax return, 4A, you're going to put that full $30,000 of IRA withdrawal. And line 4B is going to be the taxable amount. And that's only going to show $10,000 because you're going to subtract out. So logistically, that's how you're going to report it. And what that does by pulling that out of taxable income altogether is allows you to save tax dollars. So if they're in the 24% bracket most years, that $20,000 donation coming from IRA versus out of cash flow is going to save them about $4,800 in federal taxes. And if they're in North Carolina, it'll save them additional $1,000 in state income taxes. And by doing that from the IRA, it also keeps that money from coming into their taxable income calculation, from coming into their modified adjusted gross income calculation, which is what factors in for those additional Medicare premiums. So that could, in addition to those, $5,000 to $6,000 a year of state and federal income tax savings, could save them an additional $2,400 a year in Medicare premiums. So we're talking about some pretty significant savings when we add this up here. Almost half of their charitable donations they could save in state, federal, and Medicare surplus taxes by shifting those to qualified charitable distributions. Now we have one situation here. If they want to increase those charitable donations going forward, we noted that they have $1 million, I believe it was, in a TSP, Grace, and $1.5 million in an IRA. So the consideration they'll want to think about here is that those qualified charitable distributions can only happen from an IRA. And we thought with some of the recent tax code changes and the Secure Act that they might expand that to 401ks and other qualified retirement plans. However, they did not. So qualified charitable distributions can only come from an IRA. So if they want to do those for more of their RMDs as they get older and those RMDs get bigger, they might need to think about rolling over that TSP into an IRA. So they could both do qualified charitable distributions. As right now, as it stands, only Daisy would be able to do those from her IRA. Donald would not be able to direct those directly from the TSP. So those are some things they might want to think about going forward, but is a shift that would allow them to save some pretty significant tax dollars by doing those via QCD versus pulling that money into income and then writing a check.
Correct. So there's a little bit of work there and some logistical challenges they might need to work through. But that annual savings of, I believe it was roughly $9,000 per year if they have federal, state, and that savings on Medicare, that really adds up over time and can be very impactful on their finances.
Yeah. So I love talking about Disney. I love talking about Mickey and Minnie and Donald Duck and Daisy. They're some of my favorite characters. I think you all know I also have some favorite characters in pop culture and television, like George Costanza on Seinfeld. And we talk about, as we're doing our charitable donations and thinking about this, we don't want to be like George with the Human Fund. And if anybody remembers the Human Fund, it was George gave a card to his coworkers at Christmas that he had made a donation in their name to the Human Fund, which did not exist. So we really want to think about what is our intention and what are our goals and our values. What themes do we want to emphasize in our giving strategy? And some examples of that might be supporting the continuation and advancement of your religious organization, maybe enhancing access to education, eradicating disease, reducing global poverty, bettering the lives of women and girls, or supporting children and working parents. So the decision of which charities to support is very personal, and it's going to be unique for each individual and family. These may even differ between spouses. So it can be helpful to have these discussions in the context of your overall financial plan, rather than one-offs through the course of the year when you get asks for donations to a run or a event that your coworker or family member is doing. And it's important to note here that while donations to political organizations may support some of these causes, they're not tax deductible. So we do get that question a lot. So I wanted to put that distinction in there. And once you've thought about what the main themes are that you might want to emphasize in your charitable giving strategy, it may even be helpful to formulate a family giving mission statement. And we find this can be helpful, particularly when you are charitably inclined. People tend to find out about it. And a lot of times that can lead to increased asks for either higher donations to charities you're already contributing to, or other charities reaching out, family members, acquaintances, asking for donations to various causes that may not be in line with your family's goals and values as it pertains to this. So we find it can be helpful to really look through that lens of what do you want to support? What change do you want to see happen in the world? And maybe that helps you say no to some of the additional requests. And unfortunately, we have seen these come at inopportune times. For example, requests for donations at a family member's funeral or when you are grieving a loss. Unfortunately, that is fairly common. So it can help to think through some of these items before you're put in that situation. And we like to end these podcasts with a progress principle. So as we're wrapping up 2022 tax season, we think what would be best is to review what you did in 2022 and reflect on what happened last year from a charitable perspective. And is it what you would like to continue going forward, or would you like to make some changes? All right, well, we will leave you with that today. And we have lots more resources on our blog and website at financialsymmetry.com. We put these podcasts out every 2 weeks, so make sure to subscribe so you don't miss the next one.